Good afternoon, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here with my colleague Allison Schrager and a special guest today, Bill Dudley. He was the president of the New York Fed from 2009 to 2018. Folks, it's Fed Day, and policymakers are set to cut rates from a two-decade high where they've been since July 2023. But believe it or not, there's still considerable uncertainty around how much policymakers will cut. 25 basis points or 50. And at the time of writing, Fed funds futures were just around 60% odds that the Federal Open Market Committee will opt for the larger of the two options. Our panelist today, Bill Dudley, agrees with that assessment, and he's made his case in the pages of Bloomberg Opinion. Bill Dudley, why do you think the Fed should and probably will go 50 today?
Well, I think it's pretty straightforward. The Fed's has two objectives: maximum sustainable employment and price stability. And they've made a lot of progress on getting inflation back down to the 2% objective at a time where the unemployment rate has drifted up, markedly since the beginning of the year. So, as Powell said in his Jackson Hole speech, the dual mandate objectives have now come into quite close balance. And if you view that as the case, then monetary policy shouldn't be restrictive. It should be neutral. And right now, most people, including myself, think that the Fed's a long way from neutral. So it's time to get going.
Okay, and neutral is the rate at which you're neither stimulating nor holding back the economy. That being the case, what do you think has been going on behind the scenes here? I mean, you worked with the Bernanke Fed, with Yellen, with Chair Powell. What would have been going on behind the scenes in the lead up to everyone gathering at the Eccles building, and then once they're there?
Well, typically what happens is you prepare for the monetary policy meeting. The two vice chairmen, the vice chairman of the board and the vice chairman of the FOMC, the New York Fed president, and the chairman meet with the board and New York Fed staff to figure out what they want to do at the meeting and to prepare a series three alternative statements, option A, B, and C. And option B tends to be the one that's picked almost all the time. A is the dovish one, and C is the hawkish one. And so that's the prep into the meeting. What was so unusual this time was the uncertainty about what the Fed was going to do, engendered in part by two newspaper articles, one in the Financial Times and one in the Wall Street Journal, that appeared about a week ago. And those articles, they weren't definitive. They didn't say that the Fed's going to do X or the Fed's going to do Y. But what they did is they sort of opened up the question, is it going to be 25 or 50, when the markets thought that that question had been pretty much closed down and that the Fed was going to do 25. So markets started to reflect on that a little bit and conclude that, well, maybe 50 basis points, was in play for this meeting. But clearly, people are confused. To go into the meeting with a 60% probability of 50 and a 40% probability of 25, that's highly unusual. We'll see what they do. To me, the argument for 50 is quite a bit more compelling than 25. The reality is, though, we shouldn't get too worked up about this, because at the end of the day, what really matters is not how much they do at the first time they cut rates, but where are they going with the ultimate destination? And that's a question of whether, are they going to neutral, or is monetary policy going to need to be made easy? And the second part of that question is, where the heck is neutral? There's a pretty broad range in terms of where the Fed might head to get to a neutral monetary policy. Most people think it's below a 4% funds rate. Most people think it's probably above a 3% federal funds rate, but that's still a pretty broad range.
Right, and to your point, we're also going to get an update on the longer run projections for the Fed funds rate, which gives us a sense of what those policymakers do think the neutral rate is right now. I tend to think personally, and you'll correct me if I'm wrong, that they're going to find out empirically where this is and not rely on some modeled estimate. They're going to ease into it, and they'll know it when they see it.
I think they have a prior view of where neutral is, but that view is not strongly held. And as I like to joke, they're going to look outside and see how the economy is actually performing, and that's going to be how they update and modify their view of how far to go.
Yeah, and I'm gonna cut you off as we get the numbers here, and the decision is in. So it is 50 basis points. So they cut to a range of 4.75% to 5%. We've got some updates uh, to your median dot in the so-called dot plot. We have a revision for the end of 2024 to 4.4%. 2025, the median respondent sees it heading to 3.4%. And then 2.9% thereafter. That's also where the median respondent sees the so-called long run federal funds rate settling in here. I'm going to get some of the actual documentation up on the screen momentarily here, but I'll hand it over to Allison. What's your reaction here to this move? They went for 50. They did it.
Yeah, I'm obviously pleased because it's always more fun to be right than wrong. But not surprising. Were there any dissents?
I'm gonna get into that in just a moment here. Here are your headlines crossing from Bloomberg on the live blog. We have the Fed's statement. The Fed saying in its statement it's strongly committed to supporting maximum employment, 2% inflation. The Fed says that Governor Bowman dissented in favor of a 25 basis point rate cut. So there you go. We have the one dissent, Dr. Dudley.
And that's actually unusual for a board of governor member to dissent. Typically, if you have dissents, it's usually one of the Federal Reserve Bank presidents rather than a board of governors. But it is consistent with what Governor Bowman has been saying. She's been on the hawkish side. So this it's surprising in the sense that a governor dissented, but it's not surprising that it was her that dissented in the sense that she's been laying out a more hawkish position.
So I have a question for you. So in some ways, this is feels very exciting because we didn't know what they were going to do. And although, arguably you suggest they planted the idea out there that 50 rate cut was coming. No, it used to be that Fed rate decisions were always sort of surprising. And, the theory is that a surprise decision carries more economic impact than one that's choreographed out and told in advance, although arguably the communication is a tool in of itself. Do you think, I feel like Greenspan Fed was full of surprises, but starting with Bernanke, we're like, we want no surprises. Do you think in some ways we should we should have more of this, like exciting, full of surprises?
Well, it's more, it's always, drama is more fun than no drama. But no,
but also from a policy perspective, surprise decisions
I would disagree. There's been a big debate among Fed officials that spanned over the last few decades where people like Paul Volcker and Alan Greenspan were on the side of mystery and, the Wizard of Oz, man behind the curtain, don't let people see that person. And then Bernanke, Yellen, Powell, myself, all in favor of more transparency. And the reason why you want to have more transparency is that the market can anticipate what the Fed's going to do. And that means that the market can get to the appropriate place before the Federal Reserve actually moves. So think about what's happened to financial conditions over the last almost year now. They hit their peak tightness at the end of October, and they've eased significantly over the last year on anticipation that the Federal Reserve would start easing at some point. And the fact is right now, a lot of easing is priced in over the next, year and a half. I think I don't have the federal funds futures market up on my screen right now, but it's about 250 basis points of easing priced in before the meeting. So that means that the economy is already getting some benefit of the Fed's rate cuts before the Fed actually has reduced rates. So I think you want the market to be able to think along with the Fed. Now that the tricky part here is the market understanding the Fed's reaction function. What will the Fed do in response to a given set of economic information? And That's always a little bit more tricky, as we've just seen at this meeting. We weren't really sure if the Fed's reaction function to the news we've seen over the last, 6 weeks was going to lead to a 25 basis point rate cut or a 50 basis point rate cut. So the reaction function, there's always a little bit of uncertainty about. So, I think I'm a fan of transparency, but I would put a couple caveats into this. It's really important to understand that when the Fed writes down these projections, all they are their best forecasts at the time. And there's a high degree of fallibility in these forecasts. So the best example of this is go back to, March of 2022 and look at where the Fed thought the federal funds rate was going. I don't have that up in front of me, but I'm sure it wasn't 5.25 or 5.5 over the next few years. So the Fed's forecasts, are just as good, they're probably a little bit better than the average private sector forecast, but only a little. The amount of uncertainty in the world is vast relative to the ability to forecast.
Dr. Dudley, I want to take us right to those forecasts, and I've got them up on our screen. This is the September summary of economic projections,
Yep.
and if folks can hopefully read this, it shows how expectations have changed, and I'll just go sort of line by line here. For 2024, no real major change in expectations for GDP. You do have some significant upward revisions to expectations for the unemployment rate. The median respondent now sees it topping out around 4.4%.
Yep.
In 2024, sort of staying there in 2025 before coming back down to something that may be a NIRU around 4.2%. Expectations for PCE inflation, both the core and the headline, have improved a bit since the committee last put out some of these projections. I would point out that the June summary of economic projections was a little bit weird. We actually got a CPI, if you'll remember, on one of the days of the meeting, and so there were some questions around, well, is this really the most updated view of the participants? And then, as we underscored, we see some major downward revisions to the expectation for the Fed funds rate, both in 2024, 2025, and then out into 2026 and the long run. Dr. Dudley, what do you make of what you see here about the unemployment rate? Does it seem a bit too rosy, given the momentum that we've seen in this metric on the one hand, and on the other hand, what does this number tell you about the Fed's reaction function, or these combinations of numbers? What do they tell you about the reaction function?
Well, this forecast is a soft landing forecast. I mean, this is like, if they can pull this off, this is sort of as good as it gets. I mean, the unemployment rise is marginally above their estimate of what's sustainable over the long run, and inflation is coming down faster to their 2% objective than they showed in the June summary of economic projection. So this is, if it works out like this will be basically as good as it gets. No big surprises, I don't think, in the summary of economic projections. I probably would have thought that they'd have a slightly smaller rise in the unemployment rate this year than next, but not, obviously we're at 4.2 today, so it's not a big difference. But I think you can see the motivations for why they're going to cut rates quite a bit here, because inflation's coming down, unemployment rate is a bit above their long run objective, and policy is quite a bit north of neutral. I mean, if you look at the far right column for the federal funds rate, the longer run estimates for the federal funds rate, the range is from 2.4 to 3.8. So nobody on the committee believes that neutral is as high as 4% on the federal funds rate.
Right.
So that's telling you that there's quite a few rate cuts to come.
Yeah, and I think what strikes me about this is it's not only do they think they're getting a soft landing, it sounds like they think we're going back to a pre-pandemic economy with essentially like near zero, or I guess like about 100 basis points-ish, real neutral rates and effectively 2% inflation, which, I mean, do Do you think that's fair? I mean, Jean Bovin has been arguing that we're soon heading to a world where the monetary policy faces trade-offs again between inflation and unemployment, which they honestly hadn't in years pre-pandemic. Do you think we're going back to 2019 like financial conditions?
My own personal view is I don't think we're going back to 2019. I think the economy, after the great financial crisis, had an extremely long hangover. Number one. Number two, the fiscal situation today is quite a bit worse, and that has implications for the level of interest rates in the economy. Because end of the day, the so-called R-star, the neutral federal funds rate, is about what's needed to equilibrate the balance between savings and investment. And if you're running a very large chronic fiscal deficit, as far as the eye can see, that depletes the pool of savings, and that should raise what's a neutral estimate. Fed's estimate of neutral has drifted up a little bit over the last 6 months, but compared to historically, if you go back and prior to the great financial crisis, if you look at the real rate embedded in the the famous Taylor rule, it's 2%. It's not 0.8%, which is what they're showing here. The other thing that I think you have to say about these numbers is, we're not going to average 2% inflation over time. It's highly likely that inflation will be a little bit higher than that. And the reason for that, if you look at the Fed's monetary policy framework, misses to the downside get offset by misses to the upside. But misses to the upside do not get offset by misses to the downside. There's nothing in this forecast that says, we're going to run below 2% inflation for a few years to offset that very high inflation that we had in 2022 and 2023. So that means on average, inflation should be a little bit higher than 2%.
All right. I do want to go ahead and walk folks through some of the changes that we've seen in the statement, and I've put it up on the screen here. But I'm going to read some key passages because I know it's hard to read some of this text here. So starting at the very top, here is they leave the very first sentence alone, but the second sentence changes slightly. They now say job gains have slowed and the unemployment rate has moved up but remains low. It had previously said job gains have moderated, but they've swapped in the word slows. The next sentence then continues, inflation has made further progress toward the committee's 2% objective, but remains somewhat elevated. That's a little bit more of an encouraging view on inflation. They had previously said inflation has eased over the past year, but remains somewhat elevated. Actually, I'm going to edit myself. That edit there seems mostly stylistic. I'll let Bill Dudley correct me if he sees something.
Yeah, I think the changes to the first paragraph are pretty modest. I mean, they kept the solid pace in. They changed moderated to slowed. I mean, I think it's a reasonable word choice change though, because the 3 month change in payroll employment over the last 3 months is the weakest since 2020. So there definitely was a ratcheting down of the payroll employment growth rate. But yeah, I think the changes here are pretty modest, and they probably should be pretty modest because the economic outlook has not changed dramatically over the last 6 weeks.
Yeah. Well, let's now go to paragraph 2, because Bill Dudley, you were telling me there could be some interesting changes here, and indeed, in the second sentence of paragraph 2, we see this new language: the committee has gained greater confidence that inflation is moving sustainably toward 2%, and judges that the risks to achieving its employment and inflation goals are roughly in balance. What do you make of that language right there?
Well, that's sort of going back to Powell's Jackson Hole speech. And I think that's basically giving you the motivation for why they're moving rates rapidly lower, because that implies that policy should be neutral and policy is tight. And so why would you be hanging out at a tight monetary policy setting if that's your view about the balance of the risk between your two objectives?
Yeah. And then lastly, I just want to take folks to paragraph 3. The very first sentence sees some important changes, as does the very last sentence here. So we see in light of the progress on inflation, again, they're noting progress has been made. In light of the progress on inflation and the balance of risks, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75. And then lastly, this very last sentence here, I think this is critical. And this really does, again, go back to the Jackson Hole speech. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. This sentence previously said the committee is strongly committed to returning inflation to its 2% objective. The focused on the one part of the Fed's responsibilities. Now we're focusing equally on both. What do you make of that?
Well, I think that's just another example of them reinforcing that they care about both objectives now equally. So bringing the the maximum employment objective explicitly into paragraph 3 is a big change. And so essentially they're concerned about both are equal now, and therefore monetary policy should be heading towards neutral. And they're starting on that journey today.
Yeah. Well, let's talk a little bit about that journey and what's at stake here. Allison, let me bring you back in here. The parts of the economy that the real economy that we think about when we think about monetary policy have already made huge adjustments. We're already seeing mortgage rates in the low 6% range. How much do you think a day like today really matters for, say, your average American?
Probably not as much as they would like. I mean, the fact is, mortgage rates are largely based off the 10-year. And we're seeing a steepening of the yield curve. I think largely for what Dr. Dudley just brought up is sort of a very sort of bleak long-term fiscal outlook, the possibility of higher inflation in the future. So all of those would point to a higher 10-year, which is really, I think, for a lot of consumer debt, what really matters. I mean, I think it does matter to the average American in that this is the Fed effectively declaring victory on this bout of inflation. And, to some degree, maybe that becomes self-reinforcing. So this bout of inflation, might be done. And, that's definitely very good for households and they should celebrate that. But in terms of, housing market's going to be kind of wonky for a long time. I mean, a lot of people have very cheap mortgages and we're not getting back there anytime soon unless the Fed decides to revamp QE in a major way. And as I said, the 10-year is going to be higher. So I think this doesn't really have a big impact on consumer households right away, but I think it does represent inflation, which is very, very damaging to households, being the rearview mirror, at least for now.
Yeah, and your point on the 10-year is so interesting and important on a day when, on the back of this move, you see the 2-year, obviously more sensitive to monetary policy, down 5 basis points. The 10-year is actually up slightly, despite the what you might call a little bit of a dovish surprise, or I guess if we were above 50%, not quite a surprise, but a surprise to some people anyway. Dr. Dudley, similar sort of related question. There was this idea that the economy was relatively insensitive to monetary policy on the way up. So should we expect things to be quite different on the way down?
I mean, I think monetary policy was, a little bit insensitive on the way up because of the particular circumstances surrounding the pandemic and its aftermath, right? When you reopen the economy, you're going to see a lot of demand. And you're going to see a lot of demand in part because of the huge size of the fiscal transfers that occurred during the pandemic to both households and businesses. So remember, a high proportion of families got multiple checks. And when people looked at what they did with those checks initially, the conclusion was roughly a third was spent, a third was saved, and a third was used to pay down debt. So coming out of the worst part of the pandemic, when the vaccines were introduced, people had a lot of means to sustain their consumer spending, and so it took time for that sort of momentum to fade. Second thing is this: just balance sheets, are in much better shape at this point in the economic cycle than they typically are. Typically, at the end of the cycle, people are all over their skis, and you didn't have that to the same degree this time. So, and then fiscal policy has been very stimulative. I mean, on a sustained basis. So that also supported economic activity. I think the reason why the economy is finally slowing is really two areas. Number one, housing, and you can see it particularly in multifamily housing. That's turned over. And the second is low and moderate income households who had been living off of some of the savings that was generated by those fiscal transfers, but that savings had now been depleted. And those low and moderate income households do get affected by short-term rates because that affects what they have to pay to buy a car and get a car loan. That's what they have to pay on their credit card debt. That's sort of tied to more shorter-term rates. So I agree with Allison for the housing market. It's really long-term mortgage rates matter. But I think for some types of consumer spending, especially for people that don't have a lot of financial assets or don't have any financial assets, the level of short rates does still matter.
All right. Well, listen, we're going to go into a key press conference with Chair Powell in about 10 minutes. Dr. Dudley, you've worked directly, as I said, with Chair Bernanke, Chair Yellen, Chair Powell. A key question in my mind, and Allison, I'd love for you to weigh in here as well, is if Jerome Powell does achieve the fabled soft landing, this would be quite rare and quite spectacular. If he pulls it off, where will he rank in the history of this great central bank? What do you think, Dr.
I saw
Dudley?
my good friend Alan Blinder said that if he pulls it off, he'll be in the Federal Reserve Hall of Fame.
Yeah.
Look, I think it'll be a remarkable achievement, especially given where you came from, right? You would normally think if you have a really significant bout of inflation, the chances of soft landing are extremely low because monetary policy is going to have to be sufficiently tight for a period of time to drive up the unemployment rate to bring inflation down. And I think, what we learned in this cycle was that the high inflation was bad, and it obviously hurt a lot of people. But it really wasn't about monetary policy being overly stimulative. It was really mainly about the supply disruptions and the change in the composition of demand as we went into the pandemic and then came out of the pandemic. I mean, during the pandemic, people bought a lot more goods, a lot less services, so goods prices shot up. And then coming out of the pandemic, things flipped the other way. So there's a lot of frictions that were introduced to the economy. And it took time for the economy to sort of normalize. So look, I really hope that the Fed pulls it off. But, we're not there yet. And one thing that's, particularly interesting is what's happening to the unemployment rate. Claudia Sahm has authored the Sahm rule, which basically says that every time the U.S. economy has a rise in the unemployment rate of more than 0.5% over a 12-month period, 3-month moving average basis, you always end up in recession. Well, we've passed the Sahm threshold, so that suggests that there is a risk of a harder landing this time. And what the Sahm rule, I don't think you should take the Sahm rule threshold, like that literally, because that threshold was picked by the level that actually has worked in the past. And it's possible this cycle is different, and so the threshold could be a little bit higher. But the Sahm rule threshold is also pretty meaningful because not only is there a threshold, but once you go through whatever that threshold is, the next stop is a recession and a much larger rise in the unemployment rate. The smallest rise in the unemployment rate that we've had once you get past that threshold is 1.9 percentage points. So the fact that there's no observations of a 1% rise in the unemployment rate or a 1.5% rise in the unemployment rate tells you that once the labor market deteriorates beyond a certain point, it tends to be self-reinforcing. And I think I'd go back to sort of the Bob Schiller narrative idea. I think what happens is as the labor market's weakening, people start to hear about that. They start to worry about their own job. They start to pull back on consumer spending, especially on consumer durables, like cars and furniture and things like that. And that leads to less demand, which causes businesses to become less confident, and so they don't invest. And then they hire less workers, and the whole thing sort of keeps going. So, we're going to test the Sahm rule over the next 6 to 12 months, and we'll see if we make it through or not. But chances are much better than normal that we're going to make it through. But I wouldn't say that it's too soon to put the gold star on the report card quite
And
yet.
I'd argue, even if he does pull off the soft landing, I mean, I don't think his record is that impeccable. I mean, he's a great central banker. I mean, but his record is more mixed. I mean, first of all, he kept rates at zero for like a year when inflation took off. And not only that, I think what's going to be the big monetary policy error is that they kept buying mortgage-backed securities through all that, almost the entire market. And that kept mortgage rates way lower than they should have been for so much longer, which is probably going to increase, it sort of affect distortions in the housing market for like potentially decades. And so, I mean, even if he does pull off a soft landing, I don't think monetary historians should look back and be like, he was the best central banker of all time. Like, he's no Volcker.
No, it's still a good achievement. I mean, I agree with you though, Allison, that Fed was really late to tighten monetary policy. I mean, just think back to March 2020 before the meeting. The Fed was still buying securities. Interest rates were at zero. We were beyond full employment, and inflation was way above the Fed's 2% objective. What the heck were we doing at that level of monetary policy accommodation? And that was all because the Fed set up this monetary policy framework in response to the great financial crisis to try to be not preemptive, be exactly the opposite, to keep rates low for very long, to try to provide the maximum support to the economy. It's a classic example of what I call fighting the last war. Sort of like after the great financial crisis, the Fed had trouble making monetary policy sufficiently easy to keep inflation at their 2% objective, and so they said, okay, we're not going to make that mistake the next time. But the next time was a completely different economic cycle, so that monetary policy framework turned out to be deeply flawed. And I fully expect as we go through the monetary policy framework review next year, that will be scrapped. The monetary policy going forward will be much more preemptive. I mean, my ideal of a perfect monetary policy is you arrive at neutral at the same moment that you arrive at 2% inflation and full employment. And if you arrive there, then you can have the kind of economic expansion like Australia had at one point. I think Australia had an economic expansion that's stretched on for more than 25 years. If you're late, you're going to be more up and down, and you're introducing cyclicality to the economy that you don't really need to do.
All right, we have just about 3 minutes until the Jerome Powell press conference, so we're going to start winding down here. But my final question for you, Dr. Dudley, actually, I'm going to try and double barrel this here. Number one, what is your story for where we land, the destination, R star, if you like? You gave us a sense of how broad the estimates are out there, but what is your story? And number two, what would you like to hear from Chair Powell at the press conference in just a few moments?
Yeah, I would probably put neutral somewhere in the 3 to 3.5% range, but it could be as high as 4. So if I want to be imprecise, I say 3 to 4. And then the question of where we're going is all about whether we're headed toward a soft landing and policy can just be neutral, or whether we actually have a mild recession and the Fed actually has to make monetary policy easy. When we talk about soft versus hard landing, I mean, I think it's also really important to note that the chance of a deep recession here is very, very low. Because the Fed is getting started, monetary policy is already priced in. There's a lot of rate cuts have been priced in. The balance sheet of households and businesses isn't in very bad shape, and while housing isn't strong right now, housing would come roaring back if we saw a significant decline in long-term mortgage rates. So I think we're talking about the difference between no recession and mild recession, not a severe recession. The only way I think you get a severe recession is if you get an external shock, and the odds of that have probably gone up just in the last 48 hours in terms of what's going on in Israel, Israel and Lebanon. So I think that's the thing that I worry about is some external, Middle East conflagration that's much broader than what we've had up to now. That's probably how you get to a really bad outcome.
Okay, and we got a lot of information today from the statement. We got a lot of information from the summary of economic projections. But what is the information that we didn't get yet that you still want from the chair?
I don't think the press conference is going to be very interesting. I think you got pretty much, he's going to basically say once again what he said at Jackson Hole. I think he's going to be asked about what's going to happen in the next meeting and the meeting after that and how far you're going to go. And he's going to say over and over again, it depends on the data. So I think, and the summary for economic projections here is fresh and current, so you can refer to that in terms of what and I'll make the point that it reflects our current thinking, but that thinking will change as the economic information changes as well.
All right. Well, we too are always data dependent here at Bloomberg Opinion. I'm Jonathan Levin. Thank you very much to Bill Dudley, Allison Schrager. Thank you to everyone who joined us, and enjoy the press conference.